You're listening to the Financial Source podcast on YouTube.
Hi, everyone, and welcome to the Financial Source podcast.
We are definitely in a unique, maybe even tense moment right now. Global central banks seem to be signaling patience, but honestly, the outlook for inflation, for growth, it's just stubbornly uneven everywhere you look.
Yeah, exactly. And last week really drove that home, didn't it? We had those big interest rate holds from the Bank of England and the Reserve Bank of Australia.
Right.
And that set a really cautious tone, pushed markets to sort of rethink their easing expectations.
And this whole policy backdrop, it really frames a critical week for risk sentiment, especially, with the U.S.-China trade diplomacy entering a new phase now with that truce extension.
We're definitely going to unpack that Bank of England decision. That 5-4 vote for a hold was pretty unexpected. And also the Reserve Bank of Australia's core inflation forecasts, which were surprisingly high.
And we'll look ahead, too. What are the Bank of Japan and the Bank of Canada signaling about their next moves? Plus, there's crucial data coming out of China and the U.K.
We'll break down the key policy signals and market drivers you need to know for the days ahead. Let's unpack it. Okay, so let's really dig into this central idea of policy patience. It sounds good, right?
Yeah.
Central banks saying, okay, we've done enough. We can wait and see now.
Right, take a breather.
But, like you said, this wait and see thing is happening while inflation is all over the map in different countries. And we've got these big geopolitical things moving, like the U.S.-China trade truce getting extended.
Exactly. And the market is really framed by that contrast. Last week, the Bank of England and the Reserve Bank of Australia, they gave us perfect examples of this. Let's call it uneven patience.
Uneven patience, I like that.
Yeah, because the decisions weren't really just about holding the rate. It was more about how divided the committees are becoming internally. And that really sets the stage for what markets expect from, say, the Bank of Japan and the Bank of Canada this week.
Okay.
And meanwhile, we also saw Brazil and Mexico sort of clarifying their near-term easing plans, which just highlights how different things are looking across economies.
Let's start with London then, the Bank of England. They held the bank rate at 4.2%. Okay, mostly expected, but the vote split. That seems like the really big takeaway here.
Oh, absolutely. It was a 5-4 vote in favor of holding. That's more dovish than people thought.
5-4 is tight.
It's incredibly tight, and it tells you that the unified hawkish stance, it's crumbling. You had 4 members, Swati Dhingra, Dave Ramsden, Laura Breeden, who was a bit of a surprise,
Right.
and Tom Taylor. They all voted for an immediate cut.
Wow.
Yeah. So when almost half your committee wants to ease now, it tells the market the hurdle for actually cutting rates just got a lot lower. That's why you saw sterling drop and UK government bonds, gilts rally. The market suddenly sees a clearer path to a pivot.
And Governor Andrew Bailey, he talked about needing more data, right? So the September inflation number was only one series, which, okay, makes sense.
Standard central bank talk.
But then he did something pretty unusual, didn't he? He sort of nodded along with market pricing.
He basically did. The market was pricing in about 2 cuts, pushing the terminal rate, that's the implied low point for rates, down near 3.5%. And Bailey called that a fair description.
That's quite a signal from a governor.
It's huge. The official guidance tweak was small, just adding a bit more weight to inflation progress. But Bailey's comment suggests, philosophically, they're kind of aligned with where the market thinks rates are going.
So the base case is now December for a cut, assuming the data plays ball.
Strongly pointing that way. It really hinges on 3 key data points coming up. October inflation, the budget in November, and then November's inflation print in mid-December. That 5-4 split means the Doves just need one more vote to get their way.
Okay, so drama in London, but maybe even more, let's say, confusing signals came out of the Reserve Bank of Australia. They held their cash rate at 3.60%, and that was unanimous.
Right, unanimous hold. They cited caution, said maybe temporary factors pushed inflation up recently. Standard stuff. But then came their quarterly statement on monetary policy, and they sharply raised their forecasts for core inflation, like way out to mid-2026.
Raised them while holding rates.
Exactly. That's the real head scratcher. It kind of blows up the whole policy patience idea, doesn't it?
Yeah.
Because they're basically saying, yeah, we're holding steady, but actually we think inflation is going to be stickier than we thought for the next couple of years.
Okay, put some numbers on that for us. How much did they raise them?
So the trimmed, that's their preferred core inflation measure. It strips out the really volatile stuff.
Got it.
They raised the forecast for June 2026 to 3.2%. It was 2.6% before.
Okay, that's a jump.
And the overall consumer price index forecast for June 2026, that jumped to 3.7% from 3.1%. And remember, their inflation target is 2 to 3%.
So they're forecasting inflation to be well above target in mid-2026, while assuming the cash rate just stays put at 3.6%.
Yeah.
That seems difficult to reconcile.
It does, doesn't it? How can 3.6% be close to neutral if you think inflation's going to be stuck above 3% 2 years from now? Are they behind the curve? Or are they just really banking on a slowdown that isn't quite here yet?
That's the million-dollar question, I guess. What did Governor Bullock say?
Well, Michelle Bullock kept her options wide open. Said they didn't even consider a hike or a cut this meeting. And she explicitly said, look, it's possible we won't cut rates again at all. So it feels like a defensive stance. Hold steady, admit inflation might be sticky long term, but wait for the data to prove the economy is slowing down like they expect. If that slowdown doesn't happen, though, the market's going to price in hikes pretty fast.
Okay, so we've got this nervous, fractured patience in the big developed markets. Let's shift to some other economies where the signals were maybe a bit clearer, starting with the hawks.
Right, Brazil's a great example of a clear hawkish hold. They kept their Selic rate way up at 15%, third meeting in a row.
15%.
Yeah. And their reasoning is pretty structural. They're worried about tight labor markets, sure, but critically, inflation expectations are still what they call unanchored.
Meaning people just don't believe they'll hit the inflation target.
Pretty much. Businesses, the public, they expect inflation to stay high. And when expectations are unanchored, it makes the central bank's job way harder.
So what does holding at 15% signal about when they might cut?
It signals they are in no rush at all. They basically said this long pause should eventually work, but they pushed rate cut expectations out of 2025 entirely, pointing more towards early 2026. They're saying, we're willing to keep policy tight for a long time to get this right.
Wow. Okay. And up in the Nordics, also pretty firm signals.
Yeah, surprisingly firm. Sweden's Sverige of Riksbank held at 1.75%, but the language was unexpectedly upbeat. They talked about the economic recovery has started, which definitely disappointed anyone hoping for dovish hints. And Norway's Norges Bank held at 4.0%. Governor Ida Wolden Bosch was blunt. The job isn't done. There's no hurry to cut. Their own projections don't show a full rate cut until, late 2026. They are prioritizing crushing inflation over near-term growth.
Okay, so that's the hawkish side. On the easing side, we had the Bank of Mexico, Banxico. They cut 25 basis points.
They did, down to 7.25%. The cut itself wasn't a huge surprise, but the language shift was key.
How so?
They changed their forward guidance slightly. Instead of talking about assessing further adjustments, they're now just evaluating reducing the rate.
Subtle.
It's subtle, but it matters. It suggests they're slowing down the pace of easing. Maybe one more cut this year, possibly to 7.0%, and then they might pause for a while.
Right, okay. Let's pivot then from those decisions to what's coming up. And first, there's this big external factor, the U.S.-China trade truce extension. That runs until November 2026 now.
Yeah, and that provides a layer of stability that's actually pretty important for global forecasts right now.
What are the details of that deal?
It's quite broad. China is suspending retaliatory tariffs, getting rid of export controls on things like rare earths, and importantly, resuming big agricultural purchases. They're talking 12 million metric tons of soybeans by year end.
Okay, and the U.S. side?
Washington's rolling back some specific tariffs linked to fentanyl and extending exclusions on some of those Section 301 tariffs. So it dials down the temperature.
How does this trade stability feed back into the central bank outlooks we were just talking about? For Japan or Canada, for instance?
It's really relevant for them. Take the Bank of Canada. They've been talking about structural damage from the trade conflict, basically. Higher costs and lower potential output for the Canadian economy.
Right.
The truce might stabilize some of those costs, but if the damage is truly structural, permanent, then the Bank of Canada still doesn't have a lot of room to cut rates, even with a truce.
And for the Bank of Japan?
For the Bank of Japan, which is always worried about external demand, a more stable trade environment is one less major headwind as they think about maybe, eventually, normalizing their own interest rates.
Speaking of the Bank of Japan, they're releasing their summary of opinions this week. They held rates recently, but again, there was dissent, right? 7-2 vote.
Exactly. 2 members wanted a 25 basis point hike then, so the summary should give us more insight into their arguments. The overall message, though, will likely stick to Governor Ueda's very conditional language. We'll raise rates if the economy and prices perform exactly as we forecast.
Which is still a slow process for them.
Very slow. Their own projections don't see underlying inflation hitting their 2% target consistently until fiscal 2025 to 2027. So it's a long road, and this summary will tell us how impatient some members are getting.
Okay. And then Bank of Canada minutes are also out this week after they cut rates by 25 basis points down to 2.25%.
Right, that cut took them to the bottom end of what they think is the neutral range for interest rates.
So the minutes should confirm they're likely on hold now.
That's the expectation. We're looking for confirmation of that holding bias, the idea that rates are now about the right level, as they put it in their statement. We also need more clarity on how widespread the agreement was about that structural trade damage and what kind of inflation progress they need to see before they'd even think about cutting again. Being at the bottom of neutral means the bar for more cuts is probably quite high.
Okay, makes sense. Finally, let's hit the key data releases that could shift things quickly. China, first inflation data for October.
Yeah, the expectation is for pretty weak numbers. Consumer price index likely still negative year on year. Producer price index probably still subdued.
And why does that matter?
It reinforces the view that Beijing will likely need to provide more targeted policy support to boost the economy. We'll also get activity data, industrial production, retail sales, which are expected to slow a bit as some of those earlier consumer incentives wear off. It paints a picture of underlying softness.
Then the UK labor data. You mentioned this is crucial for that Bank of England 5-4 vote dynamic.
Absolutely critical. Unemployment rate is expected to tick up just a bit, maybe 4.9%. That would be okay for the Bank of England, but the real focus is wages.
Still running on.
Well, headline earnings are forecast to stay at 5.0%. The key number is earnings excluding bonuses. If that only slows down marginally, say to 4.6%, as some expect, it makes it harder for the doves. The Bank of England needs to see wage growth cooling more definitively than their own forecast predicted to give that fifth vote the confidence to flip in December.
Got it. And lastly, Australia's jobs report. Vital context for the RBA after those sticky inflation forecasts.
Yeah, the RBA needs some confirmation from the real economy. The forecast is for a fairly modest gain in employment, maybe 15,000 jobs, and the unemployment rate potentially easing slightly. The RBA needs this data to show that growth is slowing, that the economy is cooling, which would help justify their decision to hold rates despite those worrying long-term inflation numbers.
And if the jobs number's strong.
If it's strong, then the credibility of their whole patient strategy gets questioned pretty quickly.
Okay, so let's try and pull this all together.
Right. So synthesizing this, the market's really balanced on a bit of a knife edge here. You've got this fragile commitment to policy patience from the Bank of England and the Reserve Bank of Australia, but it's undermined by internal splits and these persistent inflation worries.
Right.
The U.S.-China trade truce adds a bit of stability, which is helpful. But ultimately, the incoming data, particularly UK wages, maybe Australian jobs, and just the general path of normalization in Asia, that's what's going to drive the next market moves.
And it feels like that ultimate tension really centers on the Reserve Bank of Australia, doesn't it?
Yeah.
Holding rates, but forecasting inflation to stay sticky and above target for years. It raises a really fundamental question for all central banks, I think.
Yeah.
Well, is genuine policy patience actually possible or even credible when your own internal forecasts suggest inflation is going to be a bigger problem for longer than you're maybe letting on publicly? Are they just hoping something changes?
That's exactly the complex balance, isn't it? Between uncertainty, hoping for the best, and maybe delaying the inevitable. That's what the global market is really wrestling with right now.
That balance between cautious policy patience and that lingering uncertainty, especially around inflation in places like Australia, is truly what the global market is grappling with.
That's it for today. Thanks for being here, and we really encourage you to keep a close eye on that UK labor data and the Chinese activity numbers this week. They could be quite telling.
We'll catch you in the next one on the Financial Source Podcast.